Welcome back to the channel, millionaires, future millionaires. On this channel, we talk about personal finance, the psychology of money, entrepreneurship, and investing. In this video, we're going to be talking about the stock market and investing and why you should get into the market as soon as you can. By the end of this video, you'll have an understanding of the stock market, bonds, exchange-traded funds, mutual funds, and the buying and selling of shares or stocks, as they're called, for different companies in the United States or worldwide, depending on where you're trading. So you just got done watching The Wolf on Wall Street, and you're ready to throw all your money into the market. You want to be buying fast cars, doing drugs, all the fun things in that movie, right? Stick around, I'll teach you how. So you might be asking yourself, why do people buy these securities or buy into the stock market? Well, people buy into the stock market to increase the value of the money that they invest or the money that they save. If you have money in a bank account, you might get a 1% if you're lucky. Most banks are somewhere between 0.1% and 1% interest per year, meaning that if you have $100 saved, you would gain $1 in interest every year. And that's pretty bad. You know, that's not a very good rate of return for your money. A way people can leverage their money to make them more money is by investing it in the stock market. Stocks average a return of about 2 to 12% per year over the last decade. Savings accounts, however, have only gotten 1, maybe 2% for some of the online banks like Ally Bank. And if you're going to use a bank to save your money in for long-term investments or long-term savings, I would really recommend one of the online banks that kind of restrict you in how many times you can withdraw per month or per year, but they give you a much higher rate of return than some of your big banks. I won't list them, but you know the ones I'm talking about. When you buy a stock, you're buying a portion of the company. A common analogy for owning a stock or a portion of a company is a pizza. So you take a pizza and you cut it into a bunch of different slices, and those different pieces stand for different shares of the company. Now, there's an X number of shares, that's a defined amount, but you can purchase up to however many shares, say, are for sale on the market. So when you own a share in that company, you own a bit of that company itself. And the more shares you own, the more ownership you have. Why should you buy securities or other assets for that matter? You know, why not just keep your money in a bank account or keep your money in an online bank like I mentioned and get 1, 2% interest per year? You know, that's basically free money. You have your money sitting there, your savings, and each year this bank is gonna pay you money just to have your money saved with them. It's not a bad gig, right? Well, I'm here to tell you that you could probably be making more money, in fact, a lot more money, by investing that money in the stock market. People buy stocks to increase the value of the money that they invest. On average, stocks will return about 7 to 12% per year, whereas your bank account is at the most going to do 1 to 1.5%. Most big banks usually are 0.1% to, on the really high end, 0.5%. You have a few online banks recently that have started offering 1% or sometimes up to 2% interest per year. So for every $100, you would make $1 or $2 in interest per year. But more common is a 0.1 to 0.5% return. It's not very good. There's also dividends that are paid by stocks. So when you own that piece of pie of that company, when that company has earnings, meaning they make money, or they have quarterly releases of dividends, you are given or paid a portion of their earnings depending on how many shares you own. So if they pay a dividend of a quarter per share, you own 1 share, you get a quarter. Now, that can add up really fast depending on the dividend stocks that you hold and the percentages at which they're paying out. You should also buy stocks as part of your retirement fund. It helps diversify your savings, having a variety of cash, mutual funds, bonds, stocks. It helps you build that nest egg. You know, you don't want to get to retirement age, whether that's early retirement, which I'd recommend pursuing, or, you know, your traditional age, 55, 60. But when you get there, you want to have a variety of different assets or securities saved up so that you are, you know, not worried, not scared about what's going to happen. You're able to cover your expenses, you're able to live day to day, and you aren't worried about, is that nest egg going to run out? You know, do I have enough money to make it to whatever age? And then I'm out, you know, then I'm gonna have to go back to work at 80 or I don't know. When you want to buy and sell anything on the stock market or get invested for the first time, put your first $100 towards something in the market, you have to go through something called a brokerage. that used to be something in person. If you've seen some of those old like finance movies or money movies, they're, sending paper slips and standing on the stock floor, calling and yelling at each other, but that's not how it's done anymore. Computers are the primary way that stocks and bonds and other securities are traded. They can operate faster than a human can, and they can operate faster than the human mind can even process. So we've really moved away from having, people on the floor traders, if you will, the person you would call up and say, buy me 100 shares of. That doesn't really happen anymore. We primarily use applications and software. So things like Vanguard, Fidelity, apps like Robinhood, M1 Finance, a couple other different ones. I'll go through and do reviews on a few of them and let you know which ones I use, let you know my recommendations, what I think's good about each, what I think could be improved, and where I think you should put your first $100 in the stock market. So depending on what stocks you buy, which parts of the pizza you end up owning, sometimes the value of that pizza will go up and sometimes the value of that pizza will go down. The stock market is a place for trading, supply and demand. So if more people want something, it's going to be higher valued. If less people want it, it's going to go down in value. It really just depends on what news is coming out about the company. Are they doing well? Did they beat or make more money than they expected during their earnings season? It comes down to a lot of different things. But what ends up happening is you don't know exactly how much you're going to get as a return on investment for that money. You might pay $100 and get, a stock, and after a year it's worth $105. So you've had a 5% interest. But it could also be worth $95, meaning you've lost 5%. It really just depends on what happens in the market, what happens with the company, and how they're doing. An asset that's different to that is a bond. It is a fixed payout security, meaning that you know exactly how much money you're going to make by purchasing that bond before you purchase it. There's 1 week bonds, 3-month bonds, 6 months, 5-year, 10-year. There's a variety of different types of bonds, and they all have different lengths. So that week, months, years has to do with the amount of time that you're giving that money to either, in this case, a bank usually, or a financial institution, or you're loaning that money to them temporarily, and they're going to pay you back with interest, that being the interest you made on it after the time period that bond has ended. Mutual funds are another form of security that are traded on the stock market. They're when a bunch of different people from all around the globe or all around the United States take money and pool it together to make a fund of mutual monies that they then invest in a variety of different things. They could put that money into stocks, put it into bonds, put it into exchange traded funds, put it into real estate. Pretty much any kind of security that can be purchased, a mutual fund can invest or buy in. The benefit of being involved in a mutual fund is you can usually have access to things that you as an individual investor couldn't always have access to. So say there's a stock that you want to buy, but it costs $200,000. Well, mutual funds often have access to buy fractional shares. So you can give them, say, $1,000 and they can buy a smaller fraction of that pizza, and it's worth the same as if you had bought that very tiny small slice of pizza yourself. ETFs, or exchange traded funds, are similar to mutual funds, except they're not made up of different people's money all across the globe. They're made up of different types of companies, different types of bonds, or other assets. So you take say Coca-Cola, Ford, GM, and 40 other companies and put them all together. Now you have yourself an ETF. It tracks the prices of those companies relative to the amount of each company in that unit. So there's common ETFs for the S&P 500, for the NASDAQ composite, and for most other large indexes. ETFs are one of the safest investment vehicles, and I highly recommend them because they usually average out between 100, 200, 500 companies, and the likelihood of all 500 of those companies taking a nosedive and going off the deep end and you losing money is extremely low. And the likelihood of all those companies doing that and then not recovering after 1, 2, 3 years, that hasn't happened pretty much since the 1920s. Even during the housing recession and the 08-09 crash, all that value that went down over the next decade came up, and went far surpassing what it was before the crash. The only people who lost money were people who sold when the money started going down, and people got scared thinking these things are going to go out of business, I'm not going to be able to afford things, and they sold either while the stocks were going down in value or near the bottom, And then, 2011, 12, 13, 14, all the way up until recently when we had that mini crash back in March. But if you look at that graph even now, it goes shoop, bing, and I don't know what's going to happen in the next year or two, but I know that in 10 years, my investments are going to be worth more than they are today. That's just a statistical fact, looking at market data over the last 10, 20, 30 years, that timing the market and trying to buy into the market at those low points, or saying, I'm not going to buy in at the top because that company has never been worth more, is a bad idea. Your best bet is to continually put money into the stock market, into your investments, and do something called dollar cost averaging throughout the time you're working, and just continue to put more and more money in, whether the market's going up or the market's going down. Because over time, over a decade, over 2 decades, those assets are going to become more and more and more valuable, and you're going to make more using compound interest and reinvesting the dividends than you would have, say, just trying to put all that money in at the low part and trying to time the market, if you will. So time in the market beats timing the market every time. If you want to take the first step to investing your first $100 or more into the market, I'll put a link to the app that I recommend first and foremost for new investors. It's called M1 Finance, and it allows you to build a portfolio or pizza of different stocks, ETFs, exchange traded funds, bonds, etc. Whatever it is you choose to invest in and you want to invest in, that's the app I would recommend. I'll also use a link. I'll put a link down to my profile, which is a moderate risk profile, because I'm not going to be taking money out of the market anytime soon. I plan on continuing to invest in these companies for the foreseeable future, and I see their growth as exponential based on the technology boom that's happening right now, and that's going to continue to happen over the next decade or two. I'll also do a step-by-step walkthrough of how to use M1 Finance and the recommended investments that I would say for a low risk, moderate risk, and high risk individual, and what those ratios are for getting into the stock market as a beginner. If you enjoy this kind of content and want to learn more about personal finance, the psychology of money, entrepreneurship, and the stock market, toss a like and subscribe. Comment down below any topics you want me to cover or things you think I should make a video on. I'm doing this for you guys. My whole goal here is to spread financial literacy and understanding to as many people as I can. YouTube is the best way to reach a wide audience right now, and I know that I've struggled for money at times. I know people in my life have struggled for money, and my whole goal is to try and share my financial education, my financial knowledge, and hopefully you're able to impart some part of that onto your life and live a better, more relaxing life where you have a higher level of well-being and a higher level of happiness and satisfaction. That's my goal. If you enjoy it, like and subscribe for more content. Hey. So, if you're interested in how I pick my stocks and what I want to invest in, it's this little guy right here. This is my stock picker dog. If you want to pick one of these up, I'd highly recommend it. You can find them at your local animal shelter or humane shelter. They're all really good at investing. They don't like being held so much, but they do help you pick stocks.